Hi there, welcome to The Open on BNN Bloomberg. I'm Matt Scooby in for Lindsay Biscaya today. Let's get to some of the stories that we are following in the BNN Bloomberg newsroom. Prime Minister Mark Carney is in New York to pitch Canada as an investment destination. He'll be meeting with various business leaders and will deliver remarks at the Economic Club of New York, where he will outline Canada's new economic strategy and progress made so far. The visit comes as negotiations on CUSMA begin. Dollar Tree shares are trading higher in the pre-market after the company beat profit expectations in its latest quarter. Comparable sales rose by 3.5% as the discount chain has offered higher priced items in an effort to attract a wealthier clientele. The company also raising its full-year profit forecast. Shares of BRP are up in the pre-market today. The Quebec-based maker of ski-doos and sea-doos saw stronger than expected first quarter results, helped by higher sales and improved margins across its power sports business. Revenue for BRP jumped 30% from a year earlier to over $2 billion, beating forecasts. BRP also raising its full-year revenue outlook, but lowered its profit forecast, pointing to the impact of tariffs and related costs. Want to have a look too right now at the U.S. stock futures, at least at this point, as we are half an hour away from the market's opening this morning. The Dow off slightly, at least at this point, too. The NASDAQ up a little bit. Some of the investors are going to watch this over the course of the morning, too, with the latest with what's happening in the Middle East. Another attack for right now, and we'll see where investors take this as we get through the rest of the morning today and into the rest of the afternoon. More Canadian banks have turned in their second quarter earning reports. RBC beat expectations, hiking its dividend and announcing a share buyback. TD also reported a beat, and digital bank EQB also reported today. Let's get some reaction from Tim Regan, Managing Director and Portfolio Manager at King West and Company. Tim, thanks for being here.
Thank you for having me.
Let's get into it, shall we, too? So Royal Bank, at least for interesting, we're into bank earnings seasons as we get into this, at least for Q2. You like the bank, too, at least for right now, but take me through your thoughts, at least on what we heard, too, from RBC.
Well, I mean, when you look at it, Royal Bank is firing on all cylinders. Their wealth management sector, their personal banking in Canada, their capital markets south of the border, they're doing great. I think their ROE was plus 17% plus. It is Canada's premier bank. Some people are worried about it because it's trading at a little higher than normal valuation. But over the long term, the earnings are coming in. We saw a dividend increase, share buybacks. I think, the Royal Bank, the only thing that I think can derail it is a breakup of the Canadian banking oligopoly, if Howard Lutnick tries to get that. But that's about it. Yeah,
again, very impressive stuff. I think right across the board, too, from not only RBC, right, the Canadian banks, but stick with RBC for a second. Concerns about the valuation at all, at least at this point, and for RBC in particular, and what that could mean moving forward?
It's a little high. I mean, Canadian banks usually trade at 12 times earnings, but if you look at an oligopolistic structure that earns 17% return on equity, they should be trading much higher. There's different reasons for that. So if you own it, keep it. If you're looking to buy, wait for dips.
Yep. TD also as well getting a boost from personal banking as well in the latest report too, at least at this point. Is that sustainable on the personal banking side, do you think, too, especially with economic conditions where we're talking about the affordability crisis in this country?
Well, it's interesting because TD really is two stories. And in Canada, it earns, I think it was 31% return on their capital just in Canadian retail banking. It's pretty good returns.
Big number, yeah.
The whole problem or opportunity, if you want to see it, is the U.S. They were slapped with a lot of penalties with the anti-money laundering, but their return on their U.S. banking has actually gone up because they've constrained capital down there. The one thing that TD has is they have a lot of capital to deploy, and it's how they're going to deploy that over the next number of years in profitable businesses to keep it growing. Canada, it's pretty much maxed out. I mean, there's four corners, there's 5 banks, that's about it. You're going to grow with that. So it's really looking to deploy whether it's wealth management south of the border or other areas to make it grow in the future. And they have a lot of capital for that.
You touched on the capital too. Do you like that, or where does TD go? Do you think? Do you believe here in the next year or two with that extra capital?
I mean, it's interesting because now they're getting better returns from their U.S. banking on capital and equity because they're constrained. So it was almost so. You may see them in the next couple of years go back down to the States once everything's lifted. But for now, I think they're looking for things to do. We think share buybacks are probably some of the best things to do. Probably share buybacks a year ago when the stock was cheaper. But right now, they're looking to deploy capital. And I think the new management team or the new CEO has done a very good job. So I think TD has a great runway ahead of it.
You touched on the AML, right, and the anti-money laundering, and just reputation-wise, at least for now. Are they slowly starting to put some of that behind them, and investors are feeling a little safer at this point, or how do you feel?
I think so. I think most Canadians have almost forgotten about that. You talk to someone who banks at the TD, and they'll remember it, but they still go to their bank. So I think they're getting through it. It takes a little bit. It's still costing them a little money to comply with some of the things they have to do in the States with the systems, but they are grinding their way through slowly but surely.
Mm-hmm. Can we touch on CIBC maybe just for a second too? At least for you out today too as well. Again, beating expectations at least for now. Where does CIBC fit into the mix too as we talk about the Big Five?
So CIBC has been mainly domestic, and they've put a lot of money back into asset management. They actually sold their Caribbean bank to Butterfield, took a small stake in Butterfield. It's not a big thing, but it shows that they're probably looking to focus more domestically going forward on the personal banking, wealth management as well, and the capital markets.
Right. And notice today too, in reading some of the reports, at least some of the top lines, the wealth management doing very well, at least for now, and the uptick in interest as well as we have seen too, at least in the last little bit. Is that going to continue? Do you believe here for the next couple of quarters? Or where do we see that going?
I mean, because we're in the wealth management business, we've had a great few years in the markets. And so the rising tide lifts all boats. Wealth management over the long term will continue for the banks. But, next year, if the markets go down a little bit, it'll be a little painful, but not terribly.
The interesting one, I think, in the sector, too, as well, is EQ Bank, right? Reporting second quarter results as well. Fully digital, branchless bank. So what do you like about EQB, too, as you talk about this and some of the moves that they are making?
So, I mean, we own it. We like it. We've owned it for about 6 years now. And the big thing is not even looking at their earnings, is on July 1st, they're going to close a deal with PC Financial. This is a whole new market for them. It increases their customer base. They also become the, preferred banking supplier to, I think it's 16 million members, the PC Optimum card. I'm sure you have one, I have one. You go to Loblaws or Shoppers Drug Mart. It's fantastic. So it's great. And the fact that they are digital, it's perfect for this market. They're called the Challenger Bank, and they are challenging the larger banks with a bigger runway to grow. And what's going to derail them? It could be some of their mortgages, but also now you have places like Wealthsimple, who are now offering banking services, checking. Are they going to start originating mortgages? Who knows? But now the future is pretty bright for EQB and the PC Financial deal.
How much room do you believe, right, as you look at that? I know it's hard, maybe to tell for now, but as they increase that customer base, I think in particular, it's not just a small increase either, right? Going from 800,000 to over 3 million.
Exactly. That's the customer base. Right. And then the, if they just execute in a mediocre, reasonable way, it's big. It's big. If they can really execute and start to, be better than what we think, there's an option for the future. This could be great. I've seen some analysts who think that the share price should double in the next 2 years. So we will see. But even mediocre execution brings us better returns.
Yeah, absolutely. Let me touch on, before I let you go, about Wealthsimple as well. As we talk about a little more of that competitive part of it, the the big five that have dominated for a very long time and will continue to do in this country. But for Wealthsimple and you see EQB, is there a rise coming here, do you think, a little bit, maybe just under the surface? And will they actually challenge in any ways, or are they going to just dig out their part of this sector and have their niche?
Well, they've always dug out that part of sector and had their niche. But if they do get into it and they're successful, it won't really take away much from the bigger banks, but it could be great for them. And does it provide a bit more of a rival to EQB on that side? If they go in that fashion, they will, because they are very digital. They do have I'll call it a great name out there, where a lot of people are going to Wealthsimple now. So we'll see. But more competition is better for the consumer. And it'll make our banks that we own sharper, I hope.
Very, very true. Tim, thanks for being here. Appreciate you taking some time.
Thank you.
This is Tim Regan, Managing Director and Portfolio Manager at King West & Company. Well, coming up, Prime Minister Mark Carney, as we mentioned, is in New York to pitch Canada as an investment destination today. And next week, Canada's Minister for U.S. Trade, Dominic LeBlanc, will be in Washington ahead of the July 1st deadline for the review of the CUSMA trade deal. We're going to have more on all of that coming up next. Stay with us. Canada's Minister for U.S. Trade, Dominic LeBlanc, will be in Washington next week, only weeks ahead of the July 1st deadline to review the Canada-U.S.-Mexico trade agreement. CTU's Abigail Beeman has the latest on talks.
Canada needs to hold its ground.
The former chief negotiator for the Canada-U.S.-Mexico trade deal told a Senate committee he thinks pressure on the U.S. to come to a resolution will only increase. Steve Verhoeven believes American irritants like supply-managed dairy and provinces banning liquor can be solved long-term, but not as a down payment up front. He calls autos one of the biggest challenges.
The U.S. has been taking a much more aggressive position on cars this time. And I think that this is something that Canada has to push back hard on.
Canada-U.S. Trade Minister Dominic LeBlanc tells CTV News he will head to Washington next week and says Monday he met with U.S. Trade Representative Jamieson Greer for an hour via video, joined by the current chief trade negotiator. LeBlanc feels there's too much attention on Mexico's trade talks relative to Canada. But the U.S. announced it's kicking off a first round of negotiations with Mexico this week, with no mention of Canada.
I'm hearing from contacts in Mexico that things are not going quite as quickly as the U.S. is portraying it.
Other trade experts told senators it's risky for Canada not to be included.
There is a real danger that if Canada is not present, we will just be handed a list of previously negotiated items and we'll be told sign here or don't.
John Weeks was Canada's top negotiator for the original NAFTA and says his team faced something similar on automobile rules of origin.
It was a hard slog to salvage the situation. Canada should seek to be involved in any such technical discussions.
Of course, all this comes against the backdrop of the July 1st deadline for a review of the Canada-U.S.-Mexico free trade deal.
CTV's Abigail Beeman reporting. Now, the Prime Minister announced yesterday that Canada will purchase Saab's Global Eye system for Bombardier jets to boost Arctic surveillance and defense. CTV's Judy Trin has more.
At a crowded defense conference, the Prime Minister announced a joint Swedish-Canadian venture.
Canada has entered into negotiations to procure Saab's airborne early warning and control aircraft.
Saab's Global Eye surveillance system is built on the platform of Bombardier's corporate jet. The company has at least 40 aircraft in its pipeline to be sold to Canada and other allies.
We'll be militarizing it here in Canada, not only for our own needs, but for export.
3,000 jobs could be created. Economic spin-offs are in the tens of billions of dollars.
What this will do is create a new layer of job opportunities in terms of the modifications of the aircraft. So what Bombardier is doing now is getting actively involved in the discussions to create this secondary production.
Saab beat its American competitor for its surveillance aircraft. Momentum that could improve its chances in another jet deal, selling Swedish Gripen fighters to Canada.
We can show now as a company and as a country how closely we want to work with Canada.
At the Lockheed Martin booth, the F-35 simulator and its test pilot attracts interest but not buzz. Amid U.S. trade tensions, moving forward with procuring fighter jets has been paused for more than a year, worrying Canadian suppliers who have much to lose if the F-35 isn't selected.
Direct jobs, but also strengthening the company's programs and capabilities.
Wrapping up the negotiations for these surveillance planes will likely take a few more months. As for a decision on the fighter jets, the federal government is still refusing to say when. Judy Trin, CTV News, Ottawa.
Well, coming up, U.S. GDP came in lower than what economists expected during the first quarter. We'll look at that coming up here shortly, too. And BNN Bloomberg, the managing director and head of U.S. rate strategy at TD Securities. Stay with us for that. U.S. GDP up 1.6% in its first quarter, with real PCE up $18.1 billion U.S. in April. Here to provide in-depth analysis is Kennedy Goldberg, Managing Director and Head of U.S. Rate Strategy at TD Securities. Good morning. Thanks for being here.
Thanks for having me.
And let's get into it, too. A little bit off survey at 2%, at least as expected. But, what does that mean, or what's your, initial takeaway, too, from the numbers that we did see this morning?
Yeah, I think the big takeaway here is that there was a little bit of a disappointment in terms of growth in Q1, both on the back of a little bit slower investment and slightly slower consumer. That kind of gets us into April, where we actually saw consumer spending on the PCE data, consumer incomes actually coming in relatively weak, which is a little bit tricky because you do have a fairly robust labor market, a consumer that isn't getting a ton of income, at least according to the April data, but spending that is still relatively robust. So you're seeing a lot of a drop in savings as consumers really dip into those savings to keep that spending going. So it's a little bit of a tricky setup for the Fed, which, has recently, at least according to market odds, been penciling in more rate hikes rather than rate cuts.
Yeah, it's interesting as we watch where that's going to, and I think some of the uncertainty that we've seen overall, market-wise and otherwise. But give me your sense too, in touching on the security, and we talk about that personal consumption numbers, maybe in as expected, but just dig a little deeper for us if you can into that as we watch you say dipping into savings, but just how tricky that's going to be here as we get into the next quarter and we get through the next few months.
Yeah, no, we've got a very solid labor market at the moment. It is low hire, low fire, which certainly is keeping a lot of folks on edge. The issue here is that you're not seeing significant growth in incomes, and part of that is starting to weigh a little bit on the potential for future spending. Right? If you don't have consumers who are having significant income growth, it is difficult for them to keep spending at the same rate. Now, you do have a bit of a K-shaped economy. The top echelon of consumers is spending because they do have fairly robust gains on their equity portfolios, on their investment portfolios overall. The bottom of that K-shape is struggling, and the longer this continues, the more they dip into savings, the more unsustainable it becomes. So once we get that question to the Fed, for example, should the Fed be hiking rates from here? I think the data this morning actually pushes back on that hiking narrative, which is why you saw the odds or the market pricing for a rate hike go from about 19 basis points in 2026 to about 16 basis points. So market's still pricing it in, just not quite as much as it was even earlier this morning.
And Kevin Warsh has said, too, that he wants to kind of see a wait-and-see approach, right? Doesn't want to take any action, too quickly, at least at this point. What's your best bet? You said the market is pricing that in, at least for now, but what's our best guess, at least for now, or when we might see the Fed actually look at hiking the rate?
Right. So at TD Securities, we're not looking for the Fed to deliver any rate hikes or cuts this year. We expect them to stay largely flat. We do expect rates to kind of remain fairly steady from here. We're not really looking for them to take additional action. They are in wait and see mode. It is a tricky backdrop for Fed Chair Warsh. He was basically put into place to try to get interest rates lower. At least that was President Trump's intention. It's going to be difficult to do that as inflation stays relatively elevated. Growth is still fairly robust. I think the best case scenario is the Fed keeps rates unchanged for most of the year, and that keeps interest rates overall, including the 10-year, relatively elevated, even though we do have a little bit of a downward bias by the end of the year.
You touched on, too, especially in that K-shaped economy and the lower end of it. We know that energy prices, in particular for gas and diesel, fueled on by the war and the conflict in the Middle East, that still seemingly doesn't have to have an end. We've seen investors at a couple different points, buoyed at least a little bit by the fact that we might see some sort of agreement. But where is that factoring into all of this, too, as well? Because it does feel like that's the overlying factor that's affecting all these different parts of the market and then for the consumers as well.
Absolutely. That is still the biggest overarching factor in all of this. I think that has the biggest ability to break markets one way or the other. If you get a deal that actually reopens the Strait of Hormuz, you can see oil prices fall significantly, inflation expectations start to drop off rather quickly, and interest rates can actually go lower. And I think the market stops pricing in rate hikes. The longer this persists, the longer you get this current scenario of relatively decent growth in the economy and also high inflation and expectations that with every passing day, you're going to have trouble with higher energy prices, and that's going to keep feeding through into inflation. And you may actually need the Fed to hike rates a little bit because the economy is still strong. That's the tricky part for rates investors. So, much in as much as the macro data certainly matters, and we're watching it very closely, the bigger overarching theme for markets, whether the Fed hikes or even cuts within the next 12 months, will depend very crucially on Iran. And unfortunately, there's a lot of he said, she said type of headlines from there, where you'll see headlines, they'll be refuted later in the day. Markets are just incredibly uncertain on this kind of price action. And it's keeping a lot of investors really sitting on their hands, waiting for some sort of clarity, even though it feels like these negotiations can just continue to drag on and on and on.
Yeah, it certainly is the case, at least for right now. So, and maybe, that answers my next question. My last one before I let you go to 82 is about, your expectations for Q2, because I'm assuming there's still a lot of uncertainty. But what are we looking at here, whether it's on the inflation side, too, as well for PCE?
So inflation-wise, we are looking for further upside. You've got high energy prices. All of that is going to be passing through. What we're really watching is how much of this passes through to core services prices. That's the big one for the Fed. We know core goods are being impacted to some extent by energy prices, by tariffs as well. What we want to see is how much contagion there is into services, and that's really the big one. If there isn't massive contagion, I think that'll be encouraging. Overall, we're just looking for pass-through. We're basically trying to assess the damage from the backdrop at the moment. I don't think we're going to get surprised one way or the other. The other thing we're looking for is growth. If you see the consumer slow down materially further, it is going to be difficult for the markets to sustain that hike narrative. Because at the end of the day, the Fed also wants to respond to how the economy is doing. And if the consumer is really slowing down, it's going to be troublesome for them to actually hike rates.
Kennedy Goldberg, Managing Director and Head of U.S. Rate Strategy at TD Securities. Appreciate your time today, sir. Thanks so much for this.
Thanks for having me.
Okay, the opening bells are coming up next. Stay with us. Well, here are the opening bells at the NASDAQ. Octave Intelligence ringing the opening bell. On the New York Stock Exchange, it's First Trust Advisors LP that's on the bell. And on the TSX, Global X Investments Canada is opening the market. It's time now, though, for the first 15. This is BNN Bloomberg. Trading is just getting underway right now. Let's check in on the equity markets, too, at least for right now. In the open, expecting it, and we were to be in the red, and that is the case, at least on the TSX, too, opening down over 100 points. We have some fresh attacks that happened in the Middle East with Iran and the U.S. At least for right now, that's expecting to at least cause some red, at least to start the trading day today. So we're keeping a close eye on that. The S&P down slightly to start the trading day as well, while the NASDAQ is up, at least for very briefly. But again, we are just getting underway for your trading day on this Thursday. As for some stocks that we are watching, it is all about the banks. Today, another of the three others of the big six here in Canada reporting today. We have RBC that beat expectations, hiking its dividend, and announced a share buyback as well today. TD also reporting a beat on the day today, too. A bank pointing to improving momentum in its U.S. operations with total net income reaching over $4 billion. And CIBC showing some profit gains, going to sell its Caribbean unit too as well for $1.6 billion. So that trend of the banks beating expectations continues for a second straight day. So we touched on it too. The big banks just topped earning expectations across the board, but with valuations near record highs, is there still an investment opportunity here? We're going to break that down coming up next. Well, Canadian banks have outperformed the S&P 500 by roughly 25 percentage points over the past 12 months. And this week, the Big Six beat earnings expectations. But how do they stack up as an investment opportunity amid the AI boom? Let's unpack that with Mehmet Bejderen, senior market analyst, strategist with Rosenberg Research. Thanks for being with us today.
Hi, good morning.
Let's get into it, shall we? You know, the big six Canadian banks, we talked about beating expectations this quarter. Take us through, your analysis of this, at least initially, too, and why we're seeing, at least right across the board from the banks for the quarter.
Well, I think the quarterly reports are just reinforcing the quality and capital return appeal of these assets. We wrote a report about these banks very recently, a few weeks ago, and earlier in the year. We are highlighting the quality aspect of these stocks as a tactical investment opportunity. I'm not sure about that. We try not to comment on that much. The valuations are high when you look at the historical charts, but there's a reason for it, because they offer a very quality premium asset with increasing dividends, and they create a very good diversification opportunity in a market where everything's driven by the AI craze and the euphoria. So when you look at global diversification, high profitability, dividend growth, and as you see in the quarterly reports today with the share buyback programs and earnings growth, they are looking like a gold standard. So we maintain our positive view on these stocks.
So maintaining it and for the foreseeable future too, maybe at least for now, or how long too?
Yes. So I've been answering questions about these stocks for a while now. Everyone's coming up with arguments about their valuations. Yes, when you look at the historical charts, they look at all-time highs, fine. Your cup of coffee is also on all-time highs, but you keep buying it every morning. So our argument is that you need to look at the context. There are a few good things about these stocks right now that is creating a tailwind. One is renewed interest in Canada. It's part of the hard assets mining materials trade globally, looking for non-US dollar assets, and they're benefiting from those flows. There's also an appeal from the different global asset manager, from their global asset managers' viewpoint, that they create a very good diversification against this AI euphoria. When you look at the charts of the returns of these stocks, relative to the S&P 500 and the tech or Max 7 indices, you see that they outperform when the tech universe starts to underperform. So that's a very good feature for the portfolios in our view. And also, the valuations should be compared relative to other peers. Yes, they seem a bit pricey relative to the US peers, for example, but for a good reason. When you look at their profitability, they're much higher too. Relative to Europe, yes, they're expensive for a good reason, because there are some structural issues going on in the European financials. But when you compare it to the Australian banks, for example, they are not. So Australia is another country which is having some good tailwinds from the hard assets and materials in mining and gold. And all of a sudden, when you compare them to Australians, they're not that expensive. So there is some global flow-related tailwinds behind these stocks, which seem to be delivering pretty good financial results anyway. So why not hold them?
If you've had them and if you are holding them, then you're in good shape. But what about getting in right now, too, right? We talk about the P multiples and you re-rated to historical highs, and you talk about a lot of the benefits and where we're going right now. But getting in right now is worth it, or should we be waiting, for them to come down possibly a little bit?
Okay. All right. So, yes, the trade is a bit mature compared to what you see from last year, but we still think that they have a good place in the portfolios. If you're more focused on low volatility, some income, and good profitability. So that's the investment thesis here. It's not a tactical price reaction. They might ease today maybe because of the overall market sentiment. And in the short term, they might slow down, but I think they have a worthwhile place in a global asset mix.
Which one of the big six, is really attractive to you right now? Is there one of them that stands out above the other now that we've seen, Q2 results for the last couple of days?
Well, we as a house, we are not trying to be stock specific. We make macro calls and we identify the opportunities and asset allocation strategy here. So I'd rather not make a specific call on the stocks.
Okay. For you and the Bank of Canada in particular, before I let you go, switch gears maybe just a little bit too, has been on hold here for the last little bit. We're not sure. And it, really, I'm sure, depending on what's going to happen in the Middle East about where the bank is going to go with the next rate call. What are you seeing and what are your expectations here as we get into the next quarter, next few months?
Are you asking about Bank of Canada?
Yeah, Bank of Canada. Yep.
We don't see a hike possibility as much as the market prices. I think the fears about the oil prices are a bit overdone because this is a supply shock that a central bank cannot fix. On the other hand, there are some weaknesses in the economy. So I think things are going to balance out. We agree with the viewpoint that there is a hold in the foreseeable future. And it will all depend on how the data is going to come in the summer. How does that translate into the bank stocks? I think it's a mixed bag, so it's very difficult to draw a conclusion from that. But what we see from the earnings reports is that the banks are benefiting from the capital markets a lot, just like the U.S. peers. And that's going to be, I think, a key for the Canadian banks as well. So the investors, I think, should focus on what's going on with the capital markets returns. The banks are making a lot of money from the wealth management and the other exchange-traded product fees, just like the U.S. banks. And I think any soaring mood in the equity markets later on will probably weigh on their earnings expectations as well later in the year if that happens. Otherwise, there's some good tailwinds, as I said.
Mehmet Bajarin, Senior Market Strategist at Rosenberg Research. Appreciate your time today, sir. Thanks so much for this.
Thank you. Pleasure.
Well, yesterday on Market Call, we were joined by Mike Philbrick. He is CEO at Resolve Asset Management. He was covering exchange-traded funds. His top picks were BMO Equal Weight Utilities Index ETF, iShares MSCI Global Silver, and Metals Miners ETF. iShares S&P TSX the Completion Index ETF as well. Now, today on the show, we have Greg Newman. He is a Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod. He'll be taking your questions on North American equities. Well, just ahead, we're going to put the focus back on Prime Minister Mark Carney and his trip to New York to pitch Canada as an investment destination. You're watching The Open on BNN Bloomberg. Stay with us. Well, Prime Minister Mark Carney is in New York City today for a meeting with U.S. business leaders as he tries to court more investment for Canada. For more on that, we're joined by CTV's Jeremy Sherrill, who is in our Ottawa bureau for us today. Jeremy, first up, Mark Carney, there again, we talk about the investment and what he's looking for. He has been, this has been his go-to, it feels like, over the last year, a little bit over a year since he's become Prime Minister. Take us through where we're at, because as we talk about the CUSMA review, it's happening when it comes to Mexico. They're having full-on negotiations with the United States. Canada's not at that point yet. Still, it feels like some friction. So bring us up to speed of what we're expecting today.
Yeah, Matt, look, the Prime Minister and former banker speaking to, a crowd of people he is very familiar with today in New York. He'll speak to the Economic Club of New York at noon. And as you've touched on, the pitch here is to sell Canada to investors, trying to attract major money to the country in the form of investments as he and his government look to march forward with major infrastructure projects and continue to look to build big is what the Prime Minister has continued to repeat. So a bit of a sales pitch on behalf of the Prime Minister today or for the country, trying to really attract some of those big institutional investors, which he says are looking at Canada now in a way they have not in a very long time, looking at Canada as a good place for investment, as a good place to park some of that money long term in big projects and things like that. So that's priority number one for the Prime Minister today, and kind of what is on his agenda. But all of that happening as you've touched on, Matt, we have that July 1st deadline looming, which is the window to review CUSMA, the Canada-U.S.-Mexico agreement, the trilateral agreement between the three countries. And as you've touched on, Mexico and the U.S. entering formal talks as of today, a first round of formal negotiations, while Canada and the U.S. have not started that process yet. What we know is Canada-U.S. Trade Minister Dominic LeBlanc will be heading to Washington next week. We know that on Monday he spoke with Jameson Greer, the U.S. Trade Representative. And so that is progress. Those are good signals. But we have not seen the minister travel to Washington since March. And so this will be a significant visit. We'll look for updates, of course, next week, as everyone is watching and waiting, Matt, to find out when Canada will have its turn to enter these formal talks. It would appear Canada is a little behind Mexico when it comes to getting the formal part of these negotiations underway, as the U.S. has signaled it is not ready to just green stamp this CUSMA deal and let things continue to roll on. It is widely expected that they are going to renegotiate at least some new terms and new aspects of the deal. The U.S. has been very clear it has irritants that it has highlighted. And so there are some roadblocks, it would appear, some challenges when it comes to negotiations between Canada and the U.S. And the big question is, whether or not we'll be able to continue to try and make progress and, eventually, of course, sign a new deal or make changes to the deal that exists that can be beneficial to both sides.
Yeah, and you touched on Jeremy there too. We talk about those irritants as well. Whether it's Jameson Greer's latest comments about in particular for Canada and their particular ones, at least for right now, that are on the table. But we're a month away from this, so lay out what this could look like, or the possibility of some of the different options, possibly what we look at into the summer if we don't get a deal, or because clearly Canada's reluctance, at least for right now, not jumping on board, and we've been we've been pushing back at a couple of different points here throughout the last number of months.
Yeah, look, July 1st is a deadline not to get a deal done, but a deadline to determine what the next steps are going to be. And so it is widely expected that, any kind of new terms are not going to be negotiated by July 1st. But because it is expected that the U.S. administration is not just going to rubber stamp this deal and allow for, the deal to stand as is moving forward, that, of course, by July 1st, we'll be entering kind of a review period and a renegotiation period where the two sides are going to be hammering out, the things they want to change. Jameson Greer and the U.S. administration has been pretty clear about their irritants. Supply management is one of them. Clearly, in the dairy industry, they have issues with how Canada handles some of those industries, and they want to see changes. Canada has played hardball so far on supply management, but there are questions about what happens moving forward and whether or not that could be a negotiation tool or if that will be used at all in negotiations with the U.S. Because in the past, the federal government has been clear It's a non-negotiable. Supply management is going to stay as is. The other things that we know have been irritants is U.S. alcohol being off Canadian shelves in provinces almost across the board. And then the third key irritant has been the Online Streaming Act that has become a further irritant as a result of decisions by the CRTC last week to increase the amount that U.S. streaming giants like Netflix, like Disney Plus, Amazon Prime have to reinvest into Canadian content, from 5% of their Canadian revenues being increased to 15% of their Canadian revenues they're going to have to reinvest. That's, of course, to offset the cost that Canadian broadcasters are also having to spend on Canadian content here. That decision by the CRTC also decreased the amount Canadian broadcasting companies are having to reinvest. So, putting a little bit more of the burden on the major streaming giants and taking a little bit of the pressure off Canadian broadcasters who still have to reinvest 25% of their revenues in Canadian content. So that's a major irritant. The U.S. administration has been pretty clear about that. The streaming giants are fighting that decision. Those are some of the things, Matt. And I think, the other thing that has been very clear is the U.S. administration has repeated over and over again that even countries like Canada and countries like Mexico are still going to face a baseline tariff. And Jamieson Greer has kind of signaled that Canada is taking a different approach, if you will, seem to have been a little bit more stubborn than Mexico. That is what, the signal that the U.S. administration is kind of giving. But that, we can expect, despite what Canada is looking to get out of this deal, that there will be some kind of baseline tariff, even for countries like Canada and Mexico at the end of this process.
Okay, CTV's Jeremy Sharon in Ottawa for us today. Thanks so much for the update, Jeremy.
Anytime, Matt.
Well, coming up, our next guest sounding the alarm over two diseases that are impacting Canada's oyster industry. We're going to have more on that next. Well, there's no product available this year, there won't be any next year, and none the year after that. That's the warning from one of the major players as disease continues to hit PEI's oyster industry. For more on the two diseases behind the losses, we spoke with Peter Warris, Executive Director of the PEI Aquaculture Alliance.
They're both parasites that live in the open environment. They're common in certain regions of the US and have been affecting oysters there for decades. And the industries there have survived very well in their presence, but they're new to PEI.
Okay, so when was it first noticed? When were the diseases first noticed? And I know there's a multi-year effect, but if you could expand on why that is.
The disease was first seen, MSX was first found in 2024 and Dermo in 2025. And I think the reason that it's had a longer term impact is because oysters take so long to grow. It's a three-year growth cycle.
Got it. So once it was noticed, some of those oysters became mature, I'll say, after a few years, which is why you're seeing the effect now. Tell me more about the effect.
Now, we're seeing high mortalities in quite a few areas, in some cases up to 100%. And as I mentioned before, all 3-year classes. So, that's 1-year-old, 2-year-old, and 3-year-old product. So high mortalities is really the key impact.
Give me an idea of how big the PEI oyster industry is so I can get an idea of sort of the amount of oysters being affected.
Well, we deal more on the farm side of things. The Alliance is a farm-based organization, so our members, probably about 250 active growers on the island. And in 2024, the province recorded 80 million pieces coming from the island. Now that's farmed and the public fishery as well. So last year, estimate maybe 100 million pieces. So roughly $27 to $30 million in terms of farm gate value. And then that's not taking into consideration economic spin-off, the sale of processed product. So for PEI, it's a big industry.
It's huge. Okay, so you mentioned some of this was first noticed in 2024. Were there ways to try and mitigate at all some of the fallout? If there weren't ways to mitigate it, are there forward ways to mitigate what could happen?
There are some ideas for things that could be tried, and certainly there is research going on in that area. One of the key things really is selective breeding and the development of disease resistance, and that's really where the industry in the States is so far ahead of us and have been very, very generous with sharing their expertise. As I said, these diseases have been impacting the oyster industry in the US for decades now, and they've done a lot of work in terms of selective breeding for disease resistance.
How would that work in Canada if they were sharing their knowledge with you? How quickly could something like that get underway in Canada? I guess because you mentioned it's a 3-year cycle, you wouldn't see the results of that for some time.
Yeah, well, one of our companies here also has some operations in the US, and they've been approved to import some disease-resistant seed from their operations from a hatchery down there. We've also been approved for importing some disease-resistant broodstock from Rutgers University in New Jersey. So that's a result of one of their long-term broodstock programs. And we're hoping that the seed that's imported and also being able to cross some of the local oysters with broodstock from the US is going to allow us to at least keep production turning over. And then in the longer term, we have various research groups and hatcheries who are working on local broodstock programs, selecting survivors, using modern genomic techniques to test the genetics of those survivors and their offspring, and develop local disease-resistant oysters.
That was Peter Warris, Executive Director of the PEI Aquaculture Alliance. Well, just ahead, we're going to have your latest headlines. We're going to put the focus back on bank earnings, and we are expecting the Bank of Canada's latest assessment of Canada's financial system. We're going to be back with all of that. Stay with us. Welcome to the second hour of The Open. I'm Matt Scooby. Let's have a look at some stories we're following in the BNN Bloomberg newsroom. Prime Minister Mark Carney is in New York to pitch Canada as an investment destination. He'll be meeting with various business leaders and will deliver remarks at the Economic Club of New York, where he's expected to outline Canada's new economic strategy and progress made so far. The visit comes as negotiations on CUSMA begin. Shares in Canadian Pacific Kansas City are down today. It comes as the union representing about 300 track signal workers says they will walk off the job on Sunday. It says the workers are concerned about wages, work-related experiences, and work-life balance. CKPC says railway operations will continue in the event of a strike and maintains that its offer is fair and balanced. Talks are expected to continue through the weekend. And Royal Bank saw better than expected second quarter results, helped by growth across its major businesses and lower than expected loan loss provisions. Net income rose 26% from a year earlier. RBC also raising its quarterly dividend and announced plans to buy back up to 45 million shares. Let's have a look at the market so far today in the first half hour, where the TSX is open fairly flat to some of the fresh tensions that we have seen in the Middle East, too, with some strikes from the U.S. Are tempering some of the expectations that we could see a possible peace deal. So investors maybe a little bit spooked by that as they're also assessing too some of the latest inflation figures from south of the border. As we have a look at the U.S. markets too, coming off a couple of record high days, also again opening down slightly off today, and the S&P again hovering right around the same mark, flat for right now. Oil is clawing back some of the losses that we did see too earlier in the week with some of those fresh tensions that we touched upon with Iran, but also a couple of other big stocks buoying everything up lately right now too as well. Have Dollar Tree, Snowflake, Hormel Foods piling up the profits, so that is helping stabilizing, keep things at least closer to flat to start the day on this Thursday. Well, investors are digesting second quarter earnings results from more of Canada's big six banks. Royal Bank and TD both beat estimates, and CIBC reporting an adjusted earnings beat along with plans to sell CIBC Caribbean. But CIBC shares are coming under some pressure. Let's get some reaction from Martin Cobb, Senior Vice President, Equities at Lawrence Steinberg Wealth Management. Martin, thanks for joining us.
Good morning, Matt.
So we talked about TD. Maybe we'll start there if we can too. Reporting a profit jump, stronger interest income. Give me your overall takeaway from what we saw in Q2 from TD.
Yeah, here we are. As expected, the banks have beaten expectations, and the mathematician in me kind of finds that a bit squirms a bit when I think about that. But the banks are doing well. Really, if you look across the board, and TD is no exception, although it has obviously a kind of quirk with its US operations. But the retail business is doing good. The capital markets business is doing good. The wealth management side, ticking all the boxes. So, times are good for the banks. On the loan loss provision side, yes, lower than last year because there was a lot of kind of tariff-related fears, provisioning taking place. Kind of flattish versus a quarter, ago, but probably expect to remain a little bit elevated. But no, a good set of results for TD, as we've seen for really all the banks.
Yeah, you touched on wealth management for TD, I think, in particular as well. Wholesale banking also doing well. Kind of, dig into that a little bit more and why we're seeing some of those numbers for TD in particular.
Yeah, if you just look at, wealth management industry, is it basically, what are assets doing, in terms of asset value, so stock market levels. As we've seen over the past couple of years, actually past 15 years, you could argue, markets have really gone in one direction. And then on the capital market side, obviously asset values, but also portfolio activity or trading activity has been key for these on the equity side, fixed interest side as well. So there's just a lot to like about, what's going on today. But remember, assets, stock markets are cyclical to some extent. Trading activity is cyclical to some extent, and we tend to forget about that at the top of the market, or at times like today might not be the top of the market, but when levels are stock markets are high and trading levels are active.
What about RBC too, where we had, at least for now, beating expectations, hiking its dividend, announcing a share buyback too. What are your thoughts on the Q2 results from RBC?
Yeah, Canada's best bank. I think we could debate that, and I'm not sure, many on the other side would kind of win that argument. It has been the best bank in a number of ways in terms of returns on equity. Each of its divisions, having the market leadership, creating a lot of wealth for shareholders over time. A little bit concerned about share buybacks, because when you buy something, it doesn't matter if it's a share or it doesn't matter if you're going to the groceries like I'll be doing later today. The price you pay for that, when you're buying back shares at 2.5 to 3 times book value, it's much less impactful than if you're buying them back at 1.5 times book value, where we were not that long ago. So again, like the bank, we own it over the long term, but tactically have been taking a bit of money off the table in terms of our banking exposure because of valuations.
Yeah, and you know what? When you were here last week, we touched on that too, right, Martin? And the valuations about just where they are right now, where at least and so you're taking money off, and at least for right now. But just tell us a little bit more about that too, maybe RBC, but also generally too for the Big Six.
Yeah, well, let me take you back a few years. So if you go back to the beginning of 2022, the banks back then looked a little bit expensive. We had been significantly overweight them and took our weightings down to below market weight. If you held the banks over the next couple of years, just on the next couple of years, you lost 25 to 30% of your money. The reason being is the valuations just compressed. The businesses didn't really change. They're still the great oligopoly that we know today. But when valuations get excessive, you can have a period of subpar returns to some extent. And I kind of worry a little bit that we might just get to there today. When you look at RBC, it's averaged roughly a 16% return on equity over time. Today it's a little bit higher. A couple of years ago, it was a little bit lower than that. What would you pay for that, Matt? Would you pay 2 times book value? Yeah, maybe. Would you pay 2.5? I felt that's a bit of a stretch. And today, Royal Bank is trading on 2.7 times prospective book value. So again, not egregiously expensive, but just be mindful that everything seems to be in the shop window for these companies, and investors are affording them valuations that historically have been pretty high and may lead to some short-term disappointment.
Yeah, it'll be interesting to see. CIBC too as well, reporting a beat. Too, Martin, take us through your thoughts on CIBC, where it stands and some of the performance that we've seen from that bank.
Yeah, it's funny because when I came to Canada, so we're talking 15 years ago, watching your show, I don't think you were on it then, Matt, but
I was not.
Two stocks were loathed. I'm like, why are these companies loathed? One was Manulife and the other was CIBC because it was seen as accident prone. So we launched our Canadian dividend strategy in early 2020. CIBC was our top bank pick, our biggest position in the banking sector, and it remains the case today. Operationally, they've done a great job. And you look at in terms of their growth, in terms of their cost efficiency ratios, etc., and they haven't been accident prone. The reason being we really liked it because the valuation was at such a discount to the other banks today. Now that has definitely closed the gap. They're now trading on a valuation multiple slightly above TDs. That seems a little bit high. So we still like CIBC. We like it for the long term. Like their positioning. Their Caribbean business is interesting, obviously making a sale today. That's been a nice business for them. Maybe unlike Scotia, their Caribbean operations have actually chipped in a nice chunk of profits, about 10% over time. So maybe a little bit surprised they're exiting that. I don't see any need for them to do that. But a well-run bank, but now priced as a well-run bank.
Yeah. Before I let you go, Martin, too, we've got about a minute left. A couple of quick thoughts on Best Buy, also reporting a beat, but you're rating it as sell, so outside of the banking sector. BRP, too, as well. Just touch on both of those and where you stand.
Yeah, very quickly. I mean, Best Buy, I wouldn't necessarily put it in the blockbuster camp in terms of complete obsolescence in time. They'll probably still have some sort of business, but they are running hard to stand still. Today's beat was 2% revenue growth. Last quarter was -1%. That is the range. It's really running very hard to stand still, as I say. And sometimes they'll have pockets of electronic products that sell well and the sales will be a little bit better. But I do think they're on a long-term kind of secular decline. BRP is a little bit more interesting. Like the products, would love to own one if I could convince my wife that I need one. But just the whole tariff thing is really hitting them hard. They're manufacturing in Mexico and Canada and selling more than half their sales into the US. But at some point, this too shall pass. This will get resolved, and it's a great little business.
Okay, Martin Cobb, Senior Vice President of Equities at Lawrence Steinberg Wealth Management. Appreciate your time today, Martin. Thanks again.
Thanks, Matt.
We have some breaking news coming out of the Bank of Canada today, which has just released the latest assessment of Canada's financial system. Want to show you some of the findings from the Bank of Canada. Say that the financial system has functioned well over the last year. Households, businesses are in stable financial condition. The bank also says that banks in particular have strength and capacity to absorb shocks. Bank of Canada also says high stock and corporation debt values are raising the risk of correction too. BOC also again flagging the risk of hedge funds' role in global government bonds, and U.S. tariff impacts have been less widespread than feared. The bank also saying that the Middle East war has raised uncertainty and market volatility pretty much right across the board. The bank also says that AI risks job disruption, overinvestment, and cyber attacks too. Shares of households behind on debt payments have stabilized, which is, again, good news, too, at least for right now. Well, the top risk for households and business is geopolitics and the economy. The shock of Bank of Canada is going to hold a news conference coming up at the top of the hour at 11 a.m. Tiff Macklem will miss it due to a family emergency. We'll continue to bring you some highlights of that here over the course of the morning. Well, coming up, do bonds now offer the most attractive yield opportunity in over a decade? We're going to dig into that when we come back. Stay with us. You're watching The Open. Welcome back. Do bonds now offer the most attractive yield opportunity in over a decade? Is fixed income almost solely defined by the energy crisis? We found out more when we heard from Rick Ryder, Chief Investment Officer of Global Fixed Income at BlackRock.
wake up in the morning, you look first at oil prices, and then you say, okay, where is the rate market relative at? So in a day-to-day, over an intermediate term perspective, these yields are very attractive. And, the reason why they're so attractive is the nature of the inflation transmission coming from oil, coming from global trade shock. And so it's keeping these yields at attractive levels. It's keeping central banks in a position that they may have to hike to keep inflation down. I think ultimately, if you look out 6 months, a year from now, that tenor will change, or that demeanor will change, and rates will start to come down. But for the time being, I think you have to respect the fact that interest rates aren't going to be the way you generate a lot of return in the near term.
Do you see the inflationary impact of the war as longer term at this point, a certainty for a longer term?
So I think what's happening is you have a supply shock that is much more of a short-term dynamic. You see the spot market in oil reflective of that, where the forward curve is much calmer than that. I think what happens is whenever you get a supply shock like this, you dull consumption, you dull demand, and the system tends to recalibrate down to that. Then I think what will happen is you'll start to see inflation come down. We were about to enter something that I think is where we've been entering, a productivity revolution that's pretty extraordinary that will bring inflation down. But it's going to take some time. And, in the near term, we're going to focus on energy prices, but then I think that will shift, and you'll see a calmer. We think when you get to the end of the year, particularly in the U.S., you get to 2.5 to 2 3/4 for PCE, which is the metric that the Fed follows, above target, but not terrible inflation.
Could yields rise even more? And at what point would you say there's a greater concern for equities?
It's a great question. I mean, if you said to me, there's one direction of travel, you have to pick it today. Listen, I think rates could move up a bit further from where they are today because you've got that inflation transmission in there, because you've got central banks around the world, the ECB, the Bank of Japan, the Bank of Australia, Bank of Canada, that are in this mode of potentially hiking rates or really hiking rates. And so I think you have to build into your assumption that we could go a bit higher in interest rates. I don't think we're going up that much. I've heard people say, gosh, we're going to see rates significantly higher. I don't think it's that much. For fixed income, the bigger opportunity is income. Because these yields are so high, if you keep your interest rate exposure to a moderate level and just keep clipping coupon, just keep clipping income, you can have significantly positive returns. And our funds, we've had some really nice returns, respectful of the fact that interest rates is normally, it's not the way you get there today. It's income, and you just keep that income and keep your interest rate exposure moderate.
Okay, so despite the inflation concerns, American GDP forecasts haven't really moved that much. Would you say that is on AI strength?
There are two drivers. The U.S. economy, by the way, is doing extremely well. I think you could see something like 6% nominal GDP this year. By the way, that's after 3 or 4 years of very significant growth. But it's not a broad-based growth. And this is part of why the central bank, particularly the Fed's got to think about, when do I start to bring the rate down? It's driven by AI and infrastructure spend. It's a huge amount of the CapEx spend that's coming in. And it's also driven by consumption from generally higher income net savers. It's not broad-based. And you see this in the earnings reports that are coming out today. Lower income, middle income are having a harder time. So you have an economy that is operating on a couple of cylinders. Those cylinders are doing quite well and are spending. And so it's keeping the economy in very good shape. You also have a tailwind of fiscal stimulus that's kicking in today. So my sense is you get to the latter part of the year, the growth numbers will start to come down. Not dramatically. People will think, slow down recession. Not really. But from some pretty robust numbers today, I think you'll start to see some softer numbers.
So, Rick, you say that investors need dynamic patience. What do you mean?
Yeah, one of the beautiful things I've learned over many decades, 4 decades now of doing this, is, in fixed income particularly, patience can be, is your friend. Like if you can clip a lot of coupon and you just compound that coupon, it can be really attractive. Today you can compound 6.5 in the U.S., a little lower in terms of what you're getting in Canada. But boy, those yields, as long as you're patient and you can withstand the vagaries of news flow and oil price, dynamic is something that's really important. How it's happening, there's 1.5 million securities in fixed income globally. 1.5 million. Think about how many stocks drive the equity market. Not that many. There's 1.5 million. So do you invest in EM? Like we like some of the emerging market countries. Europe has become more attractive than the U.S. today. Parts of the securitization market attractive. Investment grade credit, not so much these days. This idea that I want that coupon, I want that income, I want to compound it, but I want to move around to where the opportunity set is. Then that presents new. And by the way, new issue markets are open, financing markets are open. So this idea being, what we're trying to create is be dynamic, be aggressive around different markets, and then create something that's a stable coupon that people can sleep at night around their bond portfolio, because the equity market certainly can be more exciting.
Nick Ryder, Chief Investment Officer of Global Fixed Income at BlackRock. Well, coming up, we're going to tell you about 2 Canadian bank ETFs that look very different. Stay with us for more on that. Now, time for the ETF report with bank earnings in focus. We thought we would show you a couple of ways to play them through ETFs that do look quite different. So the 2 ETFs in focus are HMAX, which is the Hamilton Canadian Financials Yield Maximizer ETF. It aims to deliver attractive monthly income while providing exposure to a market cap-weighted portfolio of Canadian banks and insurance companies. The ETF employs a covered call option. Now, the second ETF is ZEB. It is the BMO Equal Weight Banks Index ETF. It's an exchange-traded fund designed to replicate the performance of the Selective Equal Weight Canada Banks Index. The fund seeks to invest and hold the constituent securities of the index. Let's have a look, too, at how they compare, the 2 of them, at least for now, too. And we talk about, again, some of the increases that we've seen, at least for right now. But those are your 2 ETFs, HMAX versus ZEB over the last month or so, in case you're looking to get into that part. Well, coming up, shares of Salesforce are down slightly this morning after the company gave a lukewarm outlook that failed to ease investors' concerns about AI disrupting the software business. We'll get into that coming up. The Bank of Canada says the financial system is functioning well in this country despite U.S. tariffs and uncertainty. It says households and businesses remain in stable condition, adding that lenders have strengthened their capacity to absorb financial shocks. The BOC warns, though, that a turbulent global environment poses risks to financial stability, noting that the Middle East war has raised uncertainty and market volatility. The Prime Minister is in New York today to pitch Canada as an investment destination. Mark Carney will be meeting with various business leaders and will deliver remarks at the Economic Club of New York, where he will outline Canada's new economic strategy and progress made so far. The visit comes as that CUSMA review deadline is starting to loom. And TD Bank posted second quarter earnings that beat analyst expectations as it pointed to improving momentum in its U.S. operations. Total net income reached over $4 billion. The bank also increased its quarterly dividend. TD highlighted progress in strengthening its anti-money laundering controls following recent regulatory scrutiny in the U.S. Now, look at the markets, too, at least so far today, trying to turn it around, at least briefly. We started the day in the red, too, with some of the concerns about the increase, another conflict and the increase in conflict and exchange of fire in the Middle East, too, for now. But the things back in the green, the TSX up slightly, at least for right now. We talked about the big banks that have been reported more in profits yesterday and today. CIBC, TD, and RBC all reporting earnings today. South of the border, too, the S&P 500, the NASDAQ, the Dow also into the green so far today, coming off a couple of record days yesterday. A couple of other companies outside of the banks, too. We talk about Dollar Tree, Hormel Foods, reporting some big profits today. That's going as oil is clawing back some of its losses that we saw earlier this week. Montreal Canadiens fans are snapping up team merchandise and game pucks as the team continues its series of games in series against the Hurricanes. CTV's Javid Bushaman has more on the demand for those pucks.
It's game on for NHL playoff puck production. A sport of its own, really. Thousands of logo-printed pucks have to quickly roll off the line here in Glasgow with each new playoff round. All the team's pucks are decorated here, but the hottest items, those adorned with the cherished C, says CEO Anita Chande.
We're sending just to the Canadians about 3,000 for each game. But don't forget, there's retailers all across the country right now that want a piece of this.
There's warm-up and souvenir pucks, but in Glasgow also makes official game pucks.
They're similar to the other ones, except here is where you have the sensors.
Made in Canada, logo printed in these old army barracks in Quebec's eastern townships for all 32 NHL teams, but also the PWHL. These are champions pucks for the victorious Montreal Victoire.
Fans are buying merchandise, so we have a lot of products going out this week.
Local production, she says, helps in Glasgow react quickly when teams win or lose. The company has also scored deals for a wide range of logo-printed merchandise for several other leagues and has a busy summer ahead with FIFA and the Blue Jays' 50th anniversary. The company, too, is half a century old.
It's basically like the unknown secret of Quebec.
It was started by Jason Drellet's grandfather and started out making hockey sticks.
My grandfather founded Sherwood also as the first company, which we are in the building, Sherwood building.
Its history woven into the fabric of Canada's game. And while it says it treasures its relationships with all teams, well, there's a special connection to the Habs.
I have heard that there's a few kisses and good wishes going with every puck that's going into the Bell Centre.
And soon the company will be fabricating the champions pucks with whatever logo may be on them. Geneviève Beauchemin, CTV News, Sherbrooke, Quebec.
Well, coming up, shares of Salesforce down slightly this morning after the company gave a lukewarm outlook that failed to ease some of investors' concerns about AI disrupting the software business. We're going to have more on that next. Ahead of his visit to New York, Prime Minister Mark Carney announced yesterday that Canada will purchase Saab's Global Eye system, which includes Bombardier made jets to boost Arctic surveillance and defense. CTV's Judy Trin has more.
At a crowded defense conference, the Prime Minister announced a joint Swedish-Canadian venture.
Canada has entered into negotiations to procure Saab's airborne early warning and control aircraft.
Saab's Global Eye surveillance system is built on the platform of Bombardier's corporate jet. The company has at least 40 aircraft in its pipeline to be sold to Canada and other allies.
We'll be militarizing it here in Canada, not only for our own needs, but for export.
3,000 jobs could be created. Economic spin-offs are in the tens of billions of dollars.
What this will do is create a new layer of job opportunities in terms of the modifications of the aircraft. So what Bombardier is doing now is getting actively involved in the discussions to create this secondary production.
Saab beat its American competitor for its surveillance aircraft. Momentum that could improve its chances in another jet deal, selling Swedish Gripen fighters to Canada.
We can show now as a company and as a country how closely we want to work with Canada.
At the Lockheed Martin booth, the F-35 simulator and its test pilot attracts interest but not buzz. Amid U.S. trade tensions, moving forward with procuring fighter jets has been paused for more than a year, worrying Canadian suppliers who have much to lose if the F-35 isn't selected.
Direct jobs, but also strengthening the company's programs and capabilities.
Wrapping up the negotiations for these surveillance planes will likely take a few more months. As for a decision on the fighter jets, the federal government is still refusing to say when. Judy Trin, CTV News, Ottawa.
Well, shares of Salesforce are seeing some pressure this morning after the company gave a lukewarm outlook that continued to fuel investors' worries that AI will disrupt the software industry. The decline in the stock seen today adds to Salesforce's plunge of more than 30% since the start of the year. Here to tell us more is Rishi Jaluria, Managing Director of Software Equity Research at RBC Capital Markets. Rishi, thanks for being here.
Thanks so much for having me.
So we get into it too. Salesforce revenue outlook falling slightly short of analyst expectations. Take me through some of the reaction to that we are seeing as a result of what we saw.
Yeah, absolutely. And look, I mean, now the stock's reversed course a little bit, so it's up about 2% this morning, after being down in the aftermarket. And look, I would say, generally the reaction is a lot of investors are still in wait and see mode because, as you correctly kick things off, we're dealing with these existential fears around what does AI mean for software and especially application software. And, we can get into the puts and takes of that debate. And, while I think Salesforce had what I would say was a pretty good quarter, things were, generally in line with what people expected to see. You saw really good momentum out of Agentforce. They reiterated their confidence in accelerating growth in the back half of the year and kind of sticking to their long-term targets, which called for kind of durable acceleration. All those pieces are there, but I think a lot of investors still are in, I'll believe it when I see it sort of mode, especially given all the headlines we keep hearing with, Anthropic, with OpenAI, with AI natives, and, what's happening out there. So I think that's why maybe the stock reaction is still muted, even if it's more in the upward direction today. But, if they can put up a few more quarters like this and actually deliver on what they're saying, we might be having a different conversation 6 months from now.
Right, and that's the case. And then let's, get into that a little bit more too. You touch on Agentforce too as well, right? Some of the expectations, maybe on track to contribute $1.2 billion of revenue. How significant is that, and could that be, assuming it does follow through, because we know that there have been some issues with it?
Yeah, look, I think it can be significant, right? Now I think the question starts to say, well, how much of that is cannibalizing the core, which, candidly is a right decision. I think every company needs to do that, but there are going to be questions around that. But ultimately, if this, big growth in Agentforce leads to overall acceleration in growth at the company, it's really hard to, argue that it's an AI loser, right? If they're actually accelerating growth, not decelerating it. So they kind of have to work through the puts and takes of that and think about, can they accelerate overall organic growth? I'm still on the sidelines on this because I'm also in wait and see mode. But, again, if they can actually, if Agentforce gets big enough that it becomes a needle mover on overall growth, that could be another factor that helps drive that acceleration and ultimately position Salesforce better for the next decade than it may be today.
Yeah, and can it do it, Rishi? Because, Bloomberg reporting to just last week, and we talked about the fact of what is realistic, what they are marketing Agentforce can do, what it could be, but that in actuality, when it comes to practical applications about in pharmacies or otherwise, that it's not actually doing what the company says that it's doing yet in practicality. So when you have that discrepancy, how tentative are you about that growth for it?
Yeah, and I think you hit on one of my concerns, right? Which is there's the promise of Agentforce and there's where it is today. That's not to say that gap can't narrow over time, right? And I think it fundamentally will. But I think we need to get there. Now, I think if we take a step back, though, what maybe I think starts to become a lot more important is, number one, are enterprises willing to use, adopt, and pay for Agentforce if the technology gets meaningfully better? And I think the answer to that can absolutely be yes, especially because Salesforce is already a trusted vendor within all these organizations. If they want to use Agentforce, they don't need, major permission to do that. If they want to go build their own custom agents using, Anthropic and OpenAI and Replit and Lovable, I mean, that creates a whole security and governance nightmare. And the answer to that is going to be absolutely not. So I think the technology needs to continue to improve. I've gotten the sense that Agentforce has gotten better over the past year, but there's still a lot more work to be done.
So your target for Salesforce is $210 a share, right? So we talk about $40 a share higher. Is it mostly the growth of Agentforce that you like for that, or is there something else here that Salesforce can, again, continue to improve upon for that growth?
Yeah, look, I think the answer to that, and again, I'm still generally on the sidelines, but I think two things. Number one is, there is that potential for acceleration of growth with Agentforce and maybe even just, refocusing on the core, which we've seen them do. But I think the second thing is, like, the stock is pulled back to a point that it is actually, I think, unreasonably cheap. And so even someone, a year ago, someone would have called me a Salesforce skeptic. Now I'm in the camp that I actually have to say, hey, the stock is actually, meaningfully cheaper than where I think fair value is. I do think there are other opportunities in software that might be more attractive. And, I've been steering investors in that direction. But when I see Salesforce trading at 10, 11 times cash flow, it's hard for me to say that the stock should be trading lower than where it is today.
Okay. Before I let you go, give us a sense of where you're steering, if I can ask you about that, where are you steering others to as we talk about this in software, at least for right now? It may be a couple of options.
Yeah, absolutely. Look, the number one name I'm steering people to is Microsoft. I think the innovation that they're really starting to bring to M365 Copilot is, underappreciated. And we're starting to see those early signs of momentum there. And I think they're making the right strategic moves for the long term. So I think they're going to end up in a good position out of this. One of the, a Salesforce competitor that's more in the small and medium business space, HubSpot, I think that could be a long-term beneficiary of AI. And then and hopefully I don't regret saying this in a few hours, but one name that I like a lot here is MongoDB, next-gen database company. They report tonight. It's one that I think could become the de facto platform for the development of new AI applications, especially those leveraging unstructured data. And I think these are three names that I really like here that I think are really well positioned for the next 5-10 years.
Okay, we'll check in with you later once they actually report, okay? No, I'm just kidding. Richard Deluria, Managing Director of Software Equity Research at RBC Capital Markets. Appreciate your time today, sir. Thanks for this.
Thank you.
Well, coming up, we're going to have hot picks. We're going to zero in on 3 picks in the biotech sector. After the break, stay with us for that. Well, it's time for Hot Picks, and today we're looking at 3 picks in the biotech sector. Let's get more from Laura Chico, Managing Director and Senior Biotechnology Analyst at Wedbush. Laura, thanks for being here.
Thank you very much for having me.
Before we get into the picks themselves, Laura, let's get into, just the sector itself. Was reading about keeping track and keeping at least pace with the S&P 500, but give me your sense of where biotech stocks in particular too, and where investors are going and the sense of things as they stand right now.
Yeah, and I think one thing that might surprise the viewers, you mentioned the XBI biotech ETF is slightly ahead of the S&P 500. I think it's particularly notable because the biotech has been out of favor with generalist investors for a number of years. But, overall, I think sector drivers are really flashing green lights. We're seeing a convergence of attractive valuations. M&A is back for biotech. And a lot of these companies are now embedding de-risking strategies in their development campaigns, and that helps give investors more confidence in catalysts that are coming up. So I think all in, a really positive setup for biotech.
Yeah, certainly interesting too, as you get back into favor, I think, at least in the last little bit. Let's get into some picks, shall we? First one for you, BioCryst Pharmaceuticals. Take us through this one.
Yeah, so BioCryst Pharmaceuticals, ticker BCRX, we've got a $21 target on this one. And I think this is an orphan disease company focused on hereditary angioedema, HAE for short. So about 10,000 people in the U.S., but they have a product, Orladeyo, already on the market. And this is on about a $600 million plus run rate right now. Stock is trading at about 3 times consensus revenue, but the mid-cap peer group is trading closer to 6 times. So why is the disconnect? Why a discount here? Investors are concerned about the longevity of Orladeyo's revenue tail and how long is that going to persist with other competitors coming into the HAE space. I think this is misplaced, and it's totally overlooking a recent acquisition that BioCryst did of Astria Therapeutics that brings in a late-stage program called Navenibart, another HAE preventive agent, but this one is administered only 2 to 4 times per year. So we're going to get phase 3 data on that early 27. If that looks positive, that's going to dramatically change how we treat HAE, and that's also going to solidify BioCryst positioning in the HAE space already. So I think you've also got another pipeline readout coming up year-end 26 for a different program. I love the mix of commercial and clinical catalysts here. And again, our target is $21.
Yeah, I was going to ask about the clinical part of that too, and talking about in particular. So next year, but it's 2027 in particular that you're looking at the part of this and really where you're going to see some of those results?
Yeah, for Navenibart, we will see that in the early part of 27. That's going to be that first efficacy data for Navenibart. And then that late 26 readout is for another orphan disease called Netherton syndrome. And I would argue at this point, there's 0 in the valuation for that program right now.
Okay, interesting too. How about Viridian Therapeutics? Another one, your second hot pick for the day today. Take us through that.
Yeah, so ticker VRDN, and this one here, we've got a $32 target. This is a pre-commercial name, but that could change pretty soon. They have a PDUFA date for veligrotug their program in thyroid eye disease, and that's on June 30th. So they've got breakthrough therapy designation, priority review, commercial team is hired. So this is essentially a launch-ready story. And I think what's really exciting about this one is the disconnect here between consensus revenue expectations and historical precedents. So Tepezza is already on the market for thyroid eye disease, same mechanism as Viridian. And Tepezza generated over $800 million in its first 4 quarters of launch. Consensus right now is factoring in about $300 million for Viridian over the first 8 quarters of launch. So love the setup here. Veligrotug, same target, same disease. Both are IV administered, but the Viridian program has fewer infusions and shorter infusions. So a better mousetrap kind of entering the market here for Viridian. And then, the stock has come under pressure more recently after some subcutaneous data came out for Elegrobart, their second program. But I think the second Reveal-2 data readout really more supportive. And it doesn't change anything about the Veligrotug story, which is the more immediate catalyst. So again, our target here is $32.
Okay. Maybe a longer horizon one, too. And we talk about gene therapy in lots of different parts of the medical field in particular, but Solid Biosciences, ticker SLDB. Take us through that one.
Yeah, and so this is definitely a clinical stage story, but I think, what's really exciting here is they are working on a next-gen technology for Duchenne muscular dystrophy. And this is really a devastating condition that affects young boys. Currently, I would argue somewhat limited treatment options available. So what Solid is doing differently versus the first generation, it's their capsid technology. So that's the vehicle that's delivering the gene therapy. And I think Solid's approach is a really more muscle-targeted system. So that's de-emphasizing the liver, emphasizing more muscle tissue delivery, which is exactly where you want the drug to go. They've also shown some preliminary data that looks really encouraging in terms of biomarkers, and safety has been uneventful, which is exactly what you'd want to see in this type of story. Now, they do have a phase 3 study already up and running, and the key question here is, would they be able to file for accelerated approval? And now bears are going to tell you that gene therapy can't really win with FDA right now. But I think Solid is taking, kind of a belt and suspenders approach. And they've already started to solicit positive feedback from FDA on different aspects of their program, which is a great strategy, very methodical. They are going to go back soon, have another FDA meeting to really refine what FDA needs to see in terms of endpoints. And then beyond this, we have another program with Solid already advancing in the clinic. So I think over the next 12 months, you're going to get a very more clear picture on the regulatory requirements for 03 and Duchenne, but you're also going to get validation of some clinical data for their second program. So our target here is $16, and I think for investors with a longer time horizon, this is a great idea.
Yeah, it's already up 75% since you called it out back in November, so it could be a good way, certainly, to get in. Laura Chico, Managing Director, Senior Biotechnology Analyst at Wedbush. Laura, thanks for your time today. Appreciate this.
Thanks, Matt.
Well, AI-enhanced glasses are starting to gain popularity. The wearable devices use built-in cameras, microphones, audio, and visual displays to help users with things like reading and recognizing faces. Bloomberg spoke with Wong Li, the founder and COO of Even Realties, about the smart glasses sector and how consumers are interacting with the technology.
Our strategy is to build smart glasses that people can actually wear every day. As you already tested out, and also I'm wearing this, we believe the next phase of computing is not stuff that is very bulky headset, but with lightweight eyewear that fits naturally into the daily life. So for us, the growth comes from the 3 things: the better hardware for sure, and also more useful AI experience, and also broader distribution. We are focused on products that combine optical clarity, especially for the prescription wears, and also comfort, life, and also discrete design. And also for the business is strong because I think right now people and the consumers are already shifting from the interesting gadget to practical wearables, especially for productivity, like other really practical features, and also real-time information. So that's where we are here, and also we are launching the glasses The first generation is around like 24 August, and last year we have the second generation. And also right now we are, although still early in the category, but apart from our exclusive website, we already have more than 500 global premium optical shops, including in Hong Kong, including in Singapore, in Japan, in a lot of European countries. So apart from that, we also grow really quickly in the consumer electronic shops, like the MediaMarkt, Fnac, like Yodobashi in Japan. So I think for us, the interest from consumers and the market is really grow really fast, but we need to do the product in the right way.
Right. It's a newish segment. It's new, but it's not very, very new. And there are lots of players in the market, as you know, Wang Li. So I'm curious, what do you think sets you apart? What's different about your product lineup than what's available in the market?
Yeah. I think the market right now is like the competition definitely is increasing, but definitely there are, three paths that different companies are going for. The first one definitely is camera glasses, and also definitely Meta is investing by far the most in the market. And also the second category is the display glasses as well in the market. And third one probably is the hybrid, one that both have the camera and also display together. But I think for us, like the people that are wearing camera glasses, they already arise a lot of concerns about the privacy, about their social isolation kind of thing. So we think that the biggest challenge for all the glasses that are there for the everyday definitely still the comfort, battery life, privacy, and also optical performance, and also prescription support, and finding use cases that frequently enough to become really habit. So for us, like camera glasses may appeal to some consumers, but they also create privacy concern that I said. Well, the vast majority of tech giants, they are right now focusing on the capturing, which means mounting camera on people's face for filming or for social isolation. They are not only facing, I think, a massive privacy reckoning and also legal lawsuits, but also overdrawing the public's trust. So for us, we believe the glasses in everyday life should be like utility of information, helping people deal with their daily life, daily work. So by removing the redundant cameras and also focus on discrete display and information processing, we don't report the user's past. We only empower their present. So yes, I think competition is increasing, but the category is still wide open because we have different the paths of the roadmap.
The path to the roadmap. It's interesting, right? The real use sort of case for these smart glasses is not about novelty anymore, as you say, Wang Li. I think Google was the one, the latest, that unveiled these AI glasses, is saying they're close to an inflection point in this market of mass adoption. Are you starting to see more mass adoption in the space, and what's going to get it there?
Yeah, I think for the mass adoption, first of all, definitely the product it need to be really catering to the consumer's needs in their daily life. But for the needs in their daily life, definitely we do not want the cameras to have like shot filming the others every day, every time, right? Even though the camera is not turned off or turned on. So I think for the real time assistance because it's a variable, so it can help you with your real time assistance. For that part, definitely we need context, we need AI, we need the teleprompter translation, navigation kind of real practical features to help consumers to shift their graphic UI UX interaction with your phone, with your laptop to a more conversational-based UI. That is really depending on the development of AI and agentic AI. And also, I think for the mass adoption, definitely apart from the product itself, definitely the prescription service offline, and also the distribution channel offline. For example, the optic channel and also healthcare channel that offline will help to because people can actually feel the product, not seeing that from online from other videos, so they can actually feel the product and then buy them if they have the really practical needs. So I think in that case, definitely the channels ready, and also the product is evolving, right? So we need to evolve in the right way, not to grow trust. Trust, I think, probably will be the biggest issue since it's a new category and different company want their different agenda developing all the glasses or all the wearables out there.
Well, as we get ready to hand things over to morning markets, we'll have a look at some of the biggest stock movers on the TSX today. For the biggest gainer, Tamarack Valley is higher after Raymond James upgraded Tamarack Valley Energy to outperform from market perform with a price target of $15, up from $12. That comes after the company announced it's selling some of its assets in Western Canada for $800 million. As for the biggest loser, ATS Corp, shares falling as much as 15%, the most since 2020, after the custom engineering firm gave a weaker than expected full-year revenue growth forecast. The TSX also, again, back into the green, if not slightly, for the day today, but keeping a close eye this afternoon. Well, that wraps up this edition of the Open Morning Markets. It's coming up next. Stay with us.